All right, let's get right into this one. Today, we are breaking down a really fascinating story from the world of small cap tech. It's got everything: a company practically on life support, a brilliant strategic move, and then, bam, a surprise all-cash buyout offer that just seems to come out of nowhere. This is the wild story of Cavitation Technologies. $42 million. Just let that number sink in for a second. That is the all-cash offer on the table from a European investment firm to buy up every single share of Cavitation Technologies. Now, for a company this small, that is a huge number. But what makes it truly mind-boggling is where this company was just a short while before this offer landed. And that's the real mystery here, isn't it? This isn't just a story about a buyout. It's a story of survival, of smart strategy, and of finding hidden value where nobody else was looking. So how in the world do you go from having almost no money in the bank to a multi-million-dollar payday? Well, it is quite a ride. To really understand that $42 million price tag, we have to go back in time a little bit. We need to see just how bad things really were. We're talking about a company that was, for all intents and purposes, running on fumes.
I mean, just look at this timeline. This is pulled right from their official filings. Look at September 2024. The company had $2,000 in cash. $2,000. They were literally days, maybe even hours away from not being able to pay their employees. And even after they got a little cash, by September of the next year, they were right back down to just 30 grand. That is the very definition of a company on the edge. And you know, it gets even more serious. The company's own auditors put out what's called a going concern warning. In the financial world, that is a massive, flashing red light. It's the official way for an auditor to say, hey, we are not at all confident this business is even going to exist in a year. It signals a huge risk of bankruptcy and just screams that they desperately need cash for basic everyday expenses.
So, with the clock ticking and the bank account nearly empty, the company made a move. And it was a move that was, you could say, both desperate and absolutely brilliant. They decided it was time to sell their most valuable assets, their crown jewels. Now, to get this deal, you first have to understand this relationship. Almost all, we're talking 98% of the company's revenue came from one single source, a Belgian company called Desmet. Now, being that dependent on one customer is, of course, a huge risk. But in this case, it also turned out to be their one and only lifeline. So back in October 2024, they made a deal. They sold the patents for their main business, which was in vegetable oil refining, directly to their biggest customer, Desmet. And Desmet paid them $880,000. That cash was absolutely vital. But the real genius of this deal, the most important part, is right there in step 4, the twist. They negotiated a license-back agreement. This meant they could keep using their own core technology, completely royalty-free, in any field except for the one they just sold. And that single clause, well, it changed everything.
You see, that license-back deal wasn't just some footnote in a contract. It was the key that unlocked the company's entire future. It's pretty much the whole reason we're even talking about a $42 million valuation, because it let them pivot hard. And just look at what they pivoted to. Freed from their old business, they started applying their tech to all these new high-growth areas. They're going after forever chemicals in water, which is a massive environmental problem. They're looking into super efficient cooling for data centers and Bitcoin mining, where every penny of energy costs matters. They even spun up a whole fintech subsidiary. This is a total reinvention of the company. And here's the thing, this isn't just some flimsy business plan. This whole pivot is built on a solid foundation. The company still holds over 40 patents. This is a real portfolio of intellectual property that's ready to go in these brand new markets. So here's the most important takeaway. The company that's trying to buy them, EGS, they're not paying $42 million for a struggling vegetable oil company. No way. They are paying for the potential of all these new applications. They're buying the future, not the past.
Which brings us right back to the offer itself. Now that we have the full story, the near collapse, the clever deal, the big pivot, we can finally see why this deal makes sense. And more importantly, what it means for the people who own the stock. So what does this actually mean for investors? Well, at the company's absolute low point, right around the time of that Lifeline deal, the stock was trading for less than 4 cents a share. This all-cash offer comes in at around 13 cents per share. So for any shareholder who's stuck it out through all that uncertainty, this is a huge return on their investment. And when you see it visually, the difference is just, wow. This isn't some small token premium. This is a major vote of confidence in the company's new direction. We're talking more than 3 times what the market thought the company was worth before this new strategy started to pay off. Now, a deal like this doesn't just happen. The board has to get what's called a fairness opinion. Basically, they hire an independent firm, like an investment bank, to do a really deep dive and decide if 13 cents a share is a fair price. And that firm isn't going to care about the old business. They're going to build models to guess at the future cash flow from all those new ventures, water treatment, data cooling, you name it. Their whole job is to put a number on that future potential we've been talking about. And that's just one of the hurdles they still have to clear. The buyer needs to finish their homework, they need to get that positive fairness opinion, and then, at the end of the day, the shareholders themselves get the final say. They'll vote on whether to take the deal or not. So it's a process, but the path forward is pretty clear. So after all that, what are we left with? Well, it's a really interesting question. Is this a $42 million rescue mission for a company that was about to go under? Or, if just one of these new technologies really takes off, is this actually a bargain price for a portfolio of tech that could be worth way, way more in the future? I guess only time will tell.